And it's tax attorney John Hyre, Hyre here, answering another question. These are the sorts of questions that we answer in the inner circle. You're going to notice I like to do more than just answer the question. I like to go into great detail and explain why. I think that's a lot more useful. All right, this is a super common question. For those of you who had been Inner Circle members, if you remember 2 years ago, it was two and a half years ago, I put together some slides called the Gauntlet. This is the Gauntlet again. We see a lot of people out there promoting, hey, we've got a business, it produces depreciation, it produces bonus depreciation. If you buy into our syndication, you're going to get huge tax benefits. And this is a variant on that. The list of things we look at to determine, is this legitimate, tends to be the same old list. And I'll tell you right now, what's being suggested here won't work, which is not an answer I like, but it won't work. It's being put out by a promoter who doesn't know what they're doing. You're getting different answers from CPAs because they don't know. It involves, you're going to see a lot of moving parts. CPAs are usually so busy with tax returns, which have become much more difficult in the last 10 years, that they don't have as much time to research the entire code. I am unusual in that I cover a very large breadth of the code in detail, and then I have some areas where I go super deep that are not super well known to others, such as rollover business, startups, self-directed IRAs. Coming back to this question, there are a lot of pieces we have to put together. Let's take a shot. I am a high earner W-2 employee. I created an LLC partnership with a colleague, which by the way makes this harder, to purchase spa equipment. I assume that's what capitalized SPA means. Doesn't really matter. It could be any kind of equipment. I purchased spa equipment with 20% down and an 80% loan. That makes things more complicated, especially if there's a partnership involved. So this is much easier done on your own with no debt, or done on your own with debt, but done in a partnership or with debt, or in a partnership with debt, the complexity increases, just so you know. The idea is to put 100 hours of active work in. They want this to be material participation. They don't want it to be passive. They're going to generate losses. They're going to write off all the equipment in year one. They're going to leverage to get a huge write-off. They're going to rent the equipment to someone. They're going to say, I have an equipment rental business. And by the way, I have material participation in the business. What is material participation? The opposite of passive. What's the problem with passive losses? They will not offset your W-2 income. They just hibernate. You have a W-2 of $1 million. You have passive losses of $400,000. They do not mix. You don't have $600,000 of income. The active W-2 income is still $1 million. Your $400,000 of passive losses hibernates and goes to sleep. So what they're trying to do here is convert the passive loss into significant to active loss. And the way to do that is to have participation. One way to have material participation, capital M, capital P, is to put in at least 100 hours of time into the business, and it has to be quality hours, not BS monkey work at a keyboard that isn't really businessy. There's a whole separate discussion of the quality of hours, whether it's for real estate professional status, short-term rentals, or this. The hours have to be quality hours. The IRS looks closely at that. But the idea is I put in 100 hours. Now, what they're not mentioning is you have to put in at least 100 hours. So let's say you put in 120, that's more than 100. And you have to prove that no human put in more time than you. You have to prove that every human who dealt with the business put in less than 120 hours. That's not mentioned here. And it's something you have to prove. You have to have time logs from each person who touched the property. If you don't, you lose. So that's the theory. We're going to rent out equipment. We're going to get a huge write-off, and we're going to make ourselves active instead of passive by putting in at least 100 hours. Now, I've read that I can only deduct the revenue of the LLC and no loss. That's in a separate area. Again, we're mixing parts of the code. There's something called the hobby loss rules that says if you don't have a business, you just have a hobby, like a horse farm is the classic. So people generate these huge losses on a horse farm. And the IRS says, no, you can only deduct up to the amount of revenue you made. You cannot show a net loss. Why? Because most horse farms are hobbies, not actual businesses. Well, I don't think you're renting equipment out as a hobby. It just doesn't sound like fun. Who does that? It sounds like an actual business if you put enough time, effort, and energy into it. Now, again, there's a whole separate set of case law. How much time, effort, energy do you have to put in for it to be a trader business? It's not that you just put in 100 hours at a keyboard doing monkey work. It has to be real time on a real business. So this whole limitation of not being able to take the whole loss because it's a hobby doesn't really apply here. But we're going to find there are other limitations. And different CPAs have, of course, given you different answers, but frankly, they don't really have enough information based on what you're giving them, and there are a lot of moving parts to put together. So let's walk through it. First of all, this is clearly something that's been promoted. I don't know if it's promoted by some tax consultant. Now with AI, everyone's a tax consultant. And people say, oh my God, this guy's so cheap and he's going to save me so much money. I like him much better than a real tax lawyer or a real tax accountant. I have a consultant. The consultant knows what AI tells them. They don't know the questions to ask. They're going to be wrong. I've seen it over and over. In fact, I intend to make money on it. I'll represent people in audits and in tax court when they lose and try and minimize the damage. So this is a promotion. This to me smells like a promotion. Some consultant said do this. We read an article that said do this. We asked chat and didn't ask it very well. Or this is an actual promotion because we see a lot of businesses promoted this way. Someone comes to you and says, if you do our program, we're going to save you a lot of tax money. And our program is some sort of equipment purchase and leasing thing. And by the way, almost all of them, I'm talking 98, 99% are bogus. They're not going to work for the reasons we're going to discuss. But the first thing, and I see this a lot, any tax motivated investment is very often a crappy investment. So if I'm going to invest 100 grand and I'm going to save 20 grand or 30 grand or 40 grand, but I lose the 100 grand because it's a terrible business, that makes no sense. Oh, that won't happen here because I got debt. So I'm only investing 20 grand and I'm saving 30 or 40. So if the business goes to hell, I don't care. Yeah, you do. You have to pay the debt. You took on debt. 100,000 is 100,000, whether it was 80 from you and 20 from the bank, or 100 from you, or the other way around, 20 from you, 80 from the bank. It's all real money. You have to pay it back. Don't invest in crappy businesses for tax reasons. When you invest, what are the top 3 criteria for investing? It's a good deal. It's a good deal. It's a good deal. Number 4 is taxes. Never invest because of taxes. Invest because it's a good deal. But John, actually, because I've seen some of these, the debt, I don't actually have to pay it back if things go badly. Oh, that's what we call fake debt. It's not real. That's starting to get into not nice, fraudy territory. I have seen that, especially with the film production credit. The film production credits are notorious for fake debt, that you get this huge deduction because you put in some money and you put in some debt. And so you get this huge deduction. And that's probably why it's a partnership, by the way, because you're trying to use the partnership rules that you get credit for debt. So you get this big deduction for, I put in 20% of the money and the bank put in 80%. And so I get this huge deduction, huge. What's the problem? And when someone says, I'm doing it as a partnership, that makes it harder. It makes it more complex. Why do they do this? With the film credits, the debt is fake. The debt is forgivable and almost always forgiven. I repeat, the debt is forgivable and almost always forgiven. That's a problem because it's not real debt. If you take deductions based on fake debt, you are facing at a minimum very high tax penalties if this goes south. And possibly, depending on the level of it, this could become criminalish. I mean, we don't want to do fake things with the IRS. If the debt is recourse, you're signing on the bottom line for it. You get credit for it. If your partner signs on the bottom line and you don't, the partner gets all the credit for the debt and you don't. So whoever is liable for true, honest to God, real existing debt gets credit for the debt. That's a complexity of partnership law because you have a partnership here. You've made this more complicated. This would actually be much easier if you did it on your own. There are still issues with it, but it would be easier if you did it on your own. If the debt is non-recourse, in other words, it's secured by the assets and the lender is only allowed to seize the assets, then there's a set of very complicated rules, the at-risk rules, to determine, are we going to give you any credit for the debt? In other words, you say you borrowed 80,000, but under IRS rules, if they look at non-recourse debt, they'll say, no, actually, nobody borrowed 80,000 because you're not on the hook. You didn't sign on the bottom line. So you see, this gets complex. We have a number of layers to go through. Is it a crappy business? Is the debt real? And there are different ways to determine if it's real. That's part of what I'm getting at here. Let's assume you're successful, and I have another slide that's going to cover the biggest issues of why these types of structures generally don't work. If it is successful, remember that you're limited on how much loss you can take. So Code Section 461L, excess business loss limitation. Married couples can take up to 630 grand of this kind of loss against a W-2. So if you generate, let's say, $1 million in loss, then you're going to have 370,000 carry over into a later year. So bear in mind, even if this were to work, and by the way, it doesn't, certainly not the way as presented, you would be limited on how much of these losses you're able to take. So the excess business loss limitation. Also, take a look at the last line. The business use of the equipment has to remain 51% for at least 6 years. And the reason is, if not, remember that big depreciation deduction you get in year one? Let's say in year two, the business use of the equipment falls to 0 or to 49%, same result. The business use of the equipment falls. The IRS says, oh, no. You see, remember that big deduction you took in year one? We want a lot of it back. We want most of it back, maybe with some interest. Because if you don't keep using the property, 51% in the business, there's what's called recapture. The IRS comes back and takes back, they recapture that deduction from year one. So this better be a business for 6 years. And the business use of the property better be at least 51% for 6 years. Where's the real problem here? And these people are trying to get around it, but it's being done in a very inexpert fashion. In other words, again, I'm not cracking on the person who asked the question. I'm cracking on whoever gave you the information. Somewhere, somebody gave you information for this scheme, because I don't think it's really something I would dignify with the word planning. This is a scheme, and it's by probably a tax consultant who uses AI and consequently doesn't know very much. We have an issue with the passive loss rules. Passive losses, as we talked about, do not mix with W-2s. And so what are we trying to do? Convert the passive loss into an active loss by what? Having material participation. And whoever put this together gave you part of the rules, but not all of the rules. And probably, by the way, I don't think it was intentional. I think they're just dumb. Most of the time when I see something like this and I talk to the people behind it, it's someone who really doesn't know much about taxes, and they had AI tell them, and now they're a tax consultant, and they have all these wonderful ideas that, if you know anything about taxes, are not such wonderful ideas. So what's the problem here? First of all, rentals are always passive. Pound that into your head. Rentals, whether it's equipment or real estate, are always passive, even if you have material participation. Because your 100 hours, remember what the rule that you're going for. There are 7 ways to get material participation, which means something isn't passive. One of the 7 ways, the most popular one, is you put in at least 100 hours and no other human puts in more time than you. Now, first of all, they didn't mention that other part to you because it wasn't on the first slide. And you have to be able to prove it. Everyone must track their time. Every single human that works on the property or works in the business in this case has to track their time. And if they're contractors and they help you, they have to track their time. Any human, whether they don't have to be a partner, any human has to be able to show how much time they spent. And you have to show that you spent more time than every single human and at least 100 hours. And you better track it diligently, and it better be credible. If it's round numbers or you make it up later, or you don't have time cards for all the other humans, and I mean every single other human, then you're going to have a problem. Because the IRS will go through your invoices, see who you paid. Oh, you didn't mention this management company. It has humans. Can you prove? They don't have to disprove you. They just say you have a management company you paid to do something. And you didn't prove to us that every human in the management company worked less time than you. You lose. You have to affirmatively prove it. So rentals, though, even if you're able to show the material participation, I put in more than 100 hours. I have all the time cards and I can show no human worked more time than me. Rentals are always passive. The 100-hour test does not change that. You have to show it's not a rental. This is where the Airbnb rule comes in. Airbnbs are not considered rentals. They're considered hotels, and here's why. Reg section 1.469-1TE3. If the average customer use of the rented property is 7 days or less, so what's an Airbnb? What's the average customer use? Typically around 3 to 4 days. So less than 7 days. That's not considered a rental. The IRS is saying that something where customers use the property for less than 7 days, that's a hotel. That's a hotel. And so there's a separate test. You can pass that one. Or if it's a 30-day or less rental, but you as the business owner are providing significant services. In the context of an Airbnb, I'm renting it for 29 days on average, but I come clean their room, or someone comes and cleans their room every day like a hotel. That's a significant service, which means it's not a rental. So if the average rental period is 7 days or less, or 30 days or less, but there's also significant services provided, it's not a rental, which is good, because if it's not a rental, now the 100-hour rule gets you to material participation. That's why the short-term rental loophole is so popular. That's really what we're describing here, but instead of a short-term rental, now it's equipment. Now, if it's just equipment you're renting, most rentals cannot meet the 7-day and 30-day rules, right? Most, because the IRS puts it together. Oh, I have a rental agreement. I rent to a spa, and I rent spa equipment. I got a huge depreciation write-off, and I made the contract so the rental's 7 days. It just happens to be 7 days, 52 weeks in a row is how it's going to work. The IRS just looks at it and says, that's a year rental, right? So it doesn't matter how you draft the contract. When they look at it, they're like, do different people use it for these times? Or if it's the same person constantly using it, we see what you did. No. So your problem here is you have a rental business. I don't see, based on what you told me on that slide, that you're going to meet the 7-day rule or the 30-day and significant services rule. I don't see how you're going to meet that the way an Airbnb would. You have another problem. Let's say you had short-term rentals. I had somebody that came to me on a short-term rental, this whole thing, but with short-term rental, which short-term rentals can meet this rule. A short-term rental can be defined for tax purposes as not a rental. You rent them out for less than 7 days on average to different customers. Under this rule, it's not a rental. If I put in 100 hours or more and show no one else spent more time than me, I've got material participation. I've got very large losses. This is the well-known now short-term rental loophole. Let's say you did that instead of what you're doing. You're forgetting one thing, and this is where the partnership causes a problem. In the partnership, only one. There's the Highlander rule. There can be only one. There can be only one. You see, you and your partner each have to show over 100 hours and that no other human worked more hours than you did. But if you look at the fact that you have a partner, let's say you put in 120 hours, the partner put in 110 hours. You're over 100, no other human, assuming you track them all, worked more hours than you. Can your partner say the same thing? You cannot. Your partner worked 110 hours. Who worked more than the partner? You did. So in this arrangement, the partner gets nothing. They can't show material participation. And that's a problem. That's what I mentioned in the beginning. Partnerships complicate things. Partnerships complicate things. This is a perfect example of that. If you were doing an Airbnb, I had 2 Airbnb partners who set up a partnership. And when I explained this rule, their CPA didn't have an answer. He just never thought of it. He just wasn't informed about it. They said, yeah, you got a problem. Here's what you need to do. You guys can still work together on admin and finding properties, and we can talk about a structure. But each short-term rental should be owned by one of you. So you're going to have to do 2. One of you owns one of you owns the other. Now, there are some ways you can cooperate, but you don't want to cooperate so much that what? It becomes a partnership, because then we're back here, where one partner always works more time than the other partner. So we don't want that. So what's the best way to do it? Don't have a partnership. You have to find, you can still cooperate. You just have to be very careful in terms of how you structure that. So bottom line is, this was an involved answer, but we see these schemes all the time. Here's the variant. I've seen it with solar panels, with school buses, with ATMs, every sort of equipment. The kind of equipment, the kind of thing you're writing off doesn't matter. I've walked through the traps. Partnerships make this worse. They make it more complicated, even if it does work. If it's a rental arrangement, you're never going to have material participation unless what? You can meet the 7-day test, or you can meet the less than 30 days with significant services test. Airbnbs being the classic example where you actually can do that. And that's the problem. In most cases, when it's a rental, you cannot do that. And that's why most of these 98.5, 99% of these, I've got a rental equipment business and you're going to get huge bonus depreciation that you can write off against your W-2. It doesn't work. The problem is that consultants, I don't even think most of them know they're wrong. They would have to know more than they do in order to know that. And my experience has been when you challenge them with this, they disappear.